There's a shift happening in financial plumbing almost no one is talking about. Something changed under the surface. And if you understand it, the entire Ripple versus Yellow landscape looks different. Imagine a bank treasury desk in 2026. On one screen, they see customer deposits, money market funds, and short-term treasuries. On another screen, they see tokenized dollars, real-world asset pools, and liquidity across multiple blockchains. What they care about is not which chain is fashionable. They care about which rails are regulated, which systems can plug into their core banking stack, and which networks can move size without breaking. Right now, two very different answers to that problem are taking shape. Ripple is building a regulated perimeter around banks with licenses, custody, stablecoins like RLUSD, and payment APIs that let institutions tap blockchain rails without ripping out their existing infrastructure. At the same time, Yellow Network is designing a Layer 3 clearing fabric that wants to live inside the trading flow itself, connecting exchanges, brokers, and eventually even bank cores through state channels and off-chain clearing. The tension is obvious. If you are an XRP holder or you follow Ripple closely, it is natural to wonder whether a project like Yellow is a complement, a competitor, or something more complicated, especially when you see headlines about Yellow integrating with the XRP Ledger EVM sidechain and seed funding led by Chris Larsen. Why would Ripple's co-founder back a network that looks, at first glance, like it could displace Ripple's role? This episode is about unpacking that question from first principles. We will look at Ripple's outside-in path into banking, Yellow's embedded inside-out path, how their architectures actually differ, and what this all means for the XRP Ledger in a world of multi-rail liquidity. Everything here is for educational and entertainment purposes only, not financial advice. Always do your own research before making any investment decisions. If clear, no hype crypto education helps you make sense of all this. Hit like and subscribe. It tells YouTube this series is worth showing to other newcomers, and it helps me keep building it for you. The goal is not to promote or attack either project. It is to understand the plumbing that institutions are quietly plugging into while most of the market is focused on price charts. To understand why Yellow's approach feels different, you first need a clear picture of Ripple's. Ripple has spent years building around the perimeter of the banking system rather than inside bank cores. Instead of trying to replace core systems, they have focused on regulated touchpoints, where money enters and exits the traditional rails. That starts with licensing. Ripple and its subsidiaries have accumulated a stack of registrations and permissions, money transmitter licenses, virtual asset approvals, and other regulatory footholds in key jurisdictions. The exact list is always evolving, but the pattern is clear. Ripple's bet is that if you want to move institutional size, especially in dollars or RWAs, regulators need to know who is responsible for the rails. Around that licensing core sits a growing set of products. Custody for institutions through acquisitions of bank-grade custodians. Prime brokerage features that let funds and corporates access digital asset liquidity through a single institutional front door. Payment APIs that abstract away the details of the underlying chains. And increasingly, stablecoins and tokenized treasuries that live on those chains, but are managed and supervised in a way regulators can understand. From the bank's perspective, this is an outside-in integration. The bank keeps its existing core system, ledger, and treasury tools. Ripple shows up at the edge with compliant rails. The institution plugs into those rails through APIs, connectivity partners, or specialized entities like payment firms and card networks. The core banking software might not even know it is touching a blockchain. It just knows it is talking to a regulated partner that clears and settles digital asset flows. The upside of this approach is speed of adoption. You do not need to convince core banking vendors to rewrite their software. You convince the institutions that sit around the core to add a new, regulated corridor. The downside is that you live slightly outside the deepest plumbing. You are an important rail, but not necessarily the system that holds the bank's internal order book or intraday clearing logic. Zooming in further, the backbone of Ripple's strategy is a compliance-first stack. Institutional money is constrained by rules, not only by technology. That means know your customer, transaction monitoring, capital requirements, reporting obligations, and risk frameworks that regulators sign off on. Ripple's acquisitions and partnerships start to make sense when you view them through that lens. A bank-grade custodian does more than hold keys. It provides segregation of assets, audited controls, and a regulatory perimeter that large institutions can actually use. A Prime-style interface does more than aggregate liquidity. It provides a single counterparty with a clear legal entity behind it that can be plugged into risk systems and governance frameworks. On top of that, Ripple has been moving towards instruments that look familiar to regulators. A dollar stablecoin like RLUSD is not just another token. It is a way for institutions to handle dollar exposure on-chain while staying inside a supervised framework. Tokenized treasuries and RWA structures build on the same idea. You keep the underlying legal and regulatory machinery of a bond or deposit, but you expose it as a programmable asset on the XRP Ledger or other supported rails. From an architectural perspective, all of this orbits the same idea. You keep the bank's core books and regulatory perimeter intact. You wrap new rails, new assets, and new liquidity around that perimeter under a controlled, supervised umbrella. When a bank uses Ripple, it is usually not rewriting its core ledger. It is attaching to a new, compliant corridor that can reach other institutions, payment networks, and digital asset venues. Once that perimeter is in place, the interesting part is how flows move through it. RLUSD, Ripple's dollar stablecoin, is an example of how outside-in rails connect to on-chain settlement. A treasury desk could keep its operating balances in traditional bank accounts, but use RLUSD as a way to move dollars across venues, chains, and time zones, with finality on the ledger. Add Prime-style services on top, and institutions do not have to wire funds to dozens of exchanges or over-the-counter desks. They can keep balances in a single credited relationship, while Ripple handles connectivity to underlying marketplaces and counterparties. Liquidity routing, FX paths, and cross-border corridors all become programmable policy rather than manual phone calls and spreadsheets. Treasury tools then layer policy and automation on those rails. Instead of a human desk deciding every transfer, rules can be set around exposure limits, counterparties, time windows, and currencies. Over time, this is the surface where machine-driven finance shows up. Algorithms can treat Ripple's rails and the XRP Ledger's settlement layer as primitives in larger strategies, just as they treat card networks, correspondent banks, or money markets today. So, if Ripple is building a regulated, programmable perimeter around banks, where does Yellow fit? To answer that, we have to move up a layer into the clearing fabric itself. Yellow Network starts from a different place. Instead of building a regulated perimeter around banks, it focuses on the mechanics of trading and clearing across venues and chains. Yellow describes itself as a Layer 3 clearing network. In practice, that means a mesh of nodes and state channels that sit above individual blockchains and exchanges. The core idea is simple. High-frequency trading, market making, and active liquidity provision are hard to do directly on most chains. Block times, fees, and bridge risk all get in the way. Yellow's answer is to move as much as possible off-chain into state channels. Venues, brokers, and liquidity providers connect to Yellow nodes, open channels with each other, and trade inside those channels at high speed. Only the netted result of many trades is settled back onto the underlying chain. In many ways, this mirrors what banks already do today. Most banking infrastructure relies on delayed netting cycles, end-of-day reconciliation, batched offsets between institutions, and overnight exposure windows that have barely changed in decades. Card networks, FX desks, and Treasury systems all manage risk by calculating who owes what to whom, then settling only the final positions after a closing window. It is efficient for legacy systems, but it locks banks into slow cycles, heavy reconciliation, and operational drag. Yellow's model takes that familiar clearinghouse logic and moves it into a programmable, continuous environment. Instead of one nightly close, state channels can update exposures in real time. Instead of holding risk until a batch window, institutions could choose to settle intraday, hourly, or whenever thresholds are hit. The underlying chain only sees the netted results, while the clearing fabric tracks positions with the kind of precision banks have wanted for years, but could never achieve with siloed systems. For banks, this does not feel like a foreign crypto concept. It feels like an upgrade to the clearing machinery they already depend on. A faster, more flexible, more transparent way to manage exposure across multiple venues and multiple chains. The innovation is not that settlement moves on-chain. It is that clearing becomes continuous, programmable, and free from the constraints of outdated batch-based infrastructure. This is why Yellow talks about scaling even slower chains to millions of transactions per second. The chain does not see each individual trade. It sees a small number of netted settlements, like invoices. The clearing layer in between handles who owes what to whom. To make that work across ecosystems, Yellow wraps all of this in an SDK. Developers can build applications that use Yellow's state channel infrastructure without writing low-level blockchain code. Exchanges and wallets can integrate clearing logic through familiar interfaces rather than reinventing it themselves. What matters is that, at this Layer 3 level, liquidity from multiple chains and venues can be treated as a single fabric. When you see diagrams with Ethereum, Solana, Arbitrum, and centralized exchanges at the bottom, a cross-chain custody layer in the middle, and Yellow at the top connecting brokers and market makers, that is the architecture being described. It is not another L1 or L2. It is an overlay that routes, orders, and netting between participants who already sit on various chains and platforms. The part that catches people's attention is Yellow's roadmap into banking. In public talks and X posts, Yellow's leadership has described a plan to acquire a small bank and integrate Yellow's software into a core banking provider that already serves hundreds of banks. The idea is that once the integration is certified in one institution, the same module can be offered across that core provider's client base. It is important to be precise here. As of this recording, those details are Yellow's stated strategy, not a fully documented deployment with named banks and filings, but the direction is clear enough to analyze. Instead of asking each bank to connect externally to new rails, Yellow wants to embed a crypto trading and clearing module right inside the software that banks already use to manage accounts and positions. The bank's own trading desk would be able to access crypto liquidity through that embedded module, with Yellow's Layer 3 network handling off-chain clearing behind the scenes. Parallel to that, Yellow is seeding a developer ecosystem. They sponsor hackathons, support projects using their SDK, and emphasize that Web 2-style developers can build on Yellow without needing to master every chain. Some projects already use Yellow's state channel protocol, combined with other tools like Layer 0, to move liquidity and rewards across chains. That is early-stage activity, but it shows how their infrastructure can be used beyond promotional slides. From a bank's perspective, if this model matures, it looks very different from the Ripple approach. Instead of talking to an external regulated counterparty for digital asset rails, the bank sees new screens and options inside its existing core system. Behind those screens, Yellow's Layer 3 network is routing trades, managing state channels, and settling net exposures to various chains, including the XRP Ledger EVM sidechain. When you put these two models side by side, the tension becomes clearer. Ripple is the regulated rail provider at the perimeter. Yellow wants to be the embedded clearing fabric at the center of trading. The question is whether those roles are mutually exclusive or complementary. In practice, there is room for both. A bank using Ripple for cross-border payments or stablecoin settlement still needs access to venues, order flow, and liquidity across multiple chains if it wants to offer digital asset trading or tokenized collateral strategies. Yellow does not replace Ripple's licenses, custody, or stablecoin issuance. It focuses on how orders are matched, netted, and settled between venues and participants. On the other side, Yellow's Layer 3 fabric needs points, where it meets the traditional financial system. Fiat on- and off-ramps, regulated custody, and compliant stablecoins are not optional if you want institutional size. Those are exactly the pieces Ripple has been assembling. A bank could, in theory, use Yellow's embedded clearing to route trades, while using Ripple's infrastructure for settlement in RLUSD, for cross-border flows, or for tokenized treasuries that sit on the XRP Ledger. Chris Larsen's involvement starts to make more sense under this lens. Investing in a multi-chain clearing network that embeds into venues and banks does not necessarily undercut Ripple's role. It can expand the number of paths that eventually route liquidity into the XRP Ledger, especially through the EVM sidechain. Instead of a single entry point for institutional flows, you get an ecosystem where multiple layers feed settlement into the same underlying ledger. For the XRP Ledger, the deeper question is what this architecture does to liquidity. If Yellow's model succeeds, a significant amount of trading between assets and across chains could happen off-chain inside state channels, with netted settlements landing on XRP Ledger and other ledgers. That would change the pattern of on-chain activity. You might see fewer small trades and more large periodic settlement events. At the same time, integrating Yellow with the XRP Ledger EVM sidechain creates a new category of flows. Real-world asset pools, tokenized deposits, or structured products that live on EVM-compatible rails can be traded inside Yellow's mesh, while settlement and record-keeping still land on infrastructure connected to the broader XRP ecosystem. XRP can still function as a bridge asset, where it makes economic and regulatory sense, especially when routing between pools that settle on XRP Ledger. The key is optionality. When institutions have multiple ways to reach the ledger, the system becomes less fragile. A bank can come in through a Ripple corridor, through a partner that uses Yellow, through a custodian that supports XRP Ledger natively, or through some combination of those. From a long-term perspective, that diversity of routes can reduce single-vendor risk and make XRP Ledger more resilient as part of a multi-layer settlement environment. That does not mean there are no risks. Any architecture that routes a large portion of trading off-chain into state channels concentrates operational and counterparty risk in new places. The security of Yellow's contracts, the governance of its nodes, and the regulatory treatment of its clearing activities will matter a lot if institutional volumes ever move across it. On the Ripple side, the challenge is different. Building a regulated perimeter is slow and expensive. Each jurisdiction, each license, and each product must pass scrutiny. The upside is a strong position in the eyes of regulators. The downside is that other players, including Layer 3 networks and large exchanges, may move faster in segments that are not yet fully supervised. For XRP Ledger watchers, a few signposts are worth tracking. One is how often the XRP Ledger EVM sidechain shows up as a target rail in multi-chain RWA projects and liquidity networks. Another is whether banks and custodians reference Ripple's products, Yellow's clearing fabric, or both when they talk about future infrastructure. A third is how regulators frame off-chain clearing networks in the coming years. Are they treated like traditional clearinghouses, like DeFi protocols, or something in between? None of these questions have simple answers today, and it is important to separate what is shipped from what is still roadmap. But the direction of travel is visible. The banking world is not moving toward a single chain or a single architecture. It is moving toward a layered environment where regulated rails, embedded clearing fabrics, and programmable ledgers coexist. We started with a simple tension. Ripple is building regulated digital asset rails around the banking system, while Yellow is trying to embed a clearing mesh inside trading venues, and eventually inside bank cores. On the surface, those paths can look like competition. Under the hood, they are solving different parts of the same problem. One focuses on compliance, custody, and stable instruments. The other focuses on high-speed clearing and connectivity between fragmented markets. For the XRP Ledger, that distinction matters. Ripple's stack makes XRP Ledger a credible place for institutions to settle value. Yellow's integration with the XRP Ledger EVM sidechain adds another way roots can converge on that ledger. Together, they hint at a future where XRP and XRP Ledger are not the only rails in the system, but an important part of a larger, multi-layer infrastructure. A place where regulated money, tokenized assets, and machine-driven strategies can settle against each other with finality. If you found this breakdown useful and you want more institutional, architecture-first coverage of how Ripple, XRP Ledger, and related networks are wiring into real-world finance, consider subscribing and sharing this video with someone who is still stuck between headlines and price charts. This channel will keep focusing on the plumbing, not the hype. Thanks for watching, and I'll see you in the next deep dive. This channel is for educational and entertainment purposes only, and is not financial advice. Always do your own research and keep the discussion respectful. If you enjoyed the video, please consider liking, subscribing, leaving a comment, or sharing it with a friend.